Good afternoon. We'd like to get started on time today. My name is Kim Schoenholtz. I'm delighted to welcome you to the Fall 2019 NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. So let me now briefly introduce our distinguished panelists. Seth Carpenter, to my left, is the chief U.S. economist at UBS. He also has been head of research at Rothkos Capital. Previously, Dr. Carpenter served as Assistant Secretary for Financial Markets in the U.S. Treasury. That followed a distinguished career as an economist at the Federal Reserve Board, culminating in his role as Deputy Director of the Division of Monetary Affairs. Dr. Carpenter is a member of the Council on Foreign Relations and the Congressional Budget Office's Panel of External Efforts. He received his PhD in economics from Princeton. Joyce Chang, on the far side, is a member of the Management Committee of JP Morgan's Corporate and Investment Bank, and she heads the firm's Global Research Department, which has more than 900 analysts located in 26 countries. Reflecting her #1 ranking in many analyst surveys over many years, Joyce was inducted in 2014 to the Fixed Income Analyst Society Hall of Fame. For the past 5 years, American Banker has named her one of the top 25 most powerful women in finance. She also is a member of the Council on Foreign Relations. And finally, in the middle, Constance Hunter is the chief economist for KPMG LLP. Prior to KPMG, she held high-level positions in asset management, including as chief investment officer for nearly 2 decades. At AXA, for example, she helped manage more than $500 billion in fixed income assets. Today, Constance serves as president of the National Association of Business Economists. Last but certainly not least, Constance received her undergraduate degree in economics and sociology here at NYU. That deserves a little bit of... So please join me in welcoming our panelists. Seth will now begin the presentations, followed by Joyce and Constance in that order, alphabetical. After their brief initial remarks, we'll begin the Q&A session. Thank you, Seth.
To stay sitting
There's a
at the
switch
podium?
right here, whichever you prefer.
Yeah, I'll stay here, make it more informal.
Okay, let me bring it over.
There we go.
Yep.
Excellent. Well, thank you very much, Kim. I am extraordinarily happy that Kim invited me to come for now my second time here to address this group. After I finished my PhD for 2 years, I was a professor teaching economics at the College of William & Mary, and I think just about every day miss being in the classroom, so this is just a little bit of that coming back for me. So 5 minutes to start off with to give a little bit of an outlook of the things that we're talking about with our clients about the U.S. economy. And I necessarily had to narrow it down. There are 1,001 things one could talk about. But one of the things that I don't think a single day goes by, probably not even a single conversation goes by, where we're not talking about our outlook for the U.S. economy, and importantly, how that's affected by the trade war between the United States and China. One sentence that I have said many times over the past year and a half is that the U.S. economy is strong, but for the trade war. At some point, boy, that's going to be like being in the middle of the winter in Michigan and saying that it's really, really warm except for the frigidity. So there's a saying, if you want to get across to an audience, that numbers numb, but stories store. So I will get the numbers out of the way because everyone does want to know what the forecast is. And for us, we see this year GDP growing at something like 2 to 2.25%, but next year much slower at about 1.1%. And in particular, the first half of the year, we think the growth is going to slow very, very sharply to just under 0.5% per year. And then when it comes to things that matter more directly than those sorts of numbers, the unemployment rate, we have that rising over the course of next year up to 4.3%, which is kind of remarkable. I'm old enough to remember when 4.3% was a good number, but it turns out that's not going to be a good number next year, given where we're starting. And finally, thinking about the Fed, we have the federal funds rate in our forecast coming down to 1% by September of next year. So those are the numbers. Those give the outline of the forecast. But what is the story? And for us, the story really is tariffs. And so the title of our current slide deck is Tariffs Take Us to the Brink of Recession. But what does that mean? We, last July, the beginning of July, changed our forecast for 2018 and for 2019 and said that the US economy is going to have a massive slowdown in Q4, and it's going to be induced by the tariffs. And we had any number of people throw rotten tomatoes at us, metaphorically speaking. We had people telling us that not only are we stupid, that we're also not very good looking, and we probably have relationships with our siblings. But in the event, as you can see from the chart, we went from a very, very strong middle of 2018. The blue bars are quarterly GDP growth rates, and then we had, our private domestic final purchases. So all of the spending that goes into GDP, that's domestic spending. A massive slowdown that persisted into the first quarter of this year. The black line is the unemployment rate, which had been falling over the course of this very, very long expansion. The unemployment rate peaked in 2009 and had been falling ever since. Started to rise in the fourth quarter of last year and into the first quarter of this year before resuming the decline, and then the economy bounced back in Q2. That pattern was precisely what we had written down for the pattern for the economy and economic growth and employment way back in July of last year, and it was because of the tariffs. The tariffs applied so far, if we exclude what happened on Sunday. So tariffs kicked in on, a new round of tariffs kicked in on Sunday, but until then, most of those tariffs had been on intermediate goods. Capital goods, inputs to production, bits and pieces that firms take, combine with other bits and pieces and produce output. One of my favorite analogies that has nothing to do with tariffs, but I think illustrates why we were convinced for so long that there was going to be an outsized reaction, is Ford. So Ford's single most profitable vehicle is their F-150 pickup truck. They produce F-150s in 4 different assembly plants in 4 different states. And one auto parts producer out of the hundreds of auto parts producers in the United States, let alone the world, had a fire, couldn't produce air conditioning units. And so Ford's production across 4 different facilities for F-150s, their most profitable model, went from full capacity to 0. Because of this one auto parts supplier. And it stayed at 0 for 3 weeks, and then it went right back up to full capacity. Now, they didn't make up for lost time, because it turns out you can't produce more than full capacity, otherwise it wouldn't be full capacity. But that kind of nonlinearity is exactly what you should always expect to see when you see disruptions to supply chains. And so what happened in Q4 of last year was that a lot of manufacturers who were importing goods said, wow, I just can't pay 25% more for that input. And so I'm going to wait for a while. I'm going to suspend production for a while until I can find a cheaper supplier. Turns out when manufacturers suspend production, their workers go on unemployment insurance for a while until they go back to work. And sure enough, at the same time we saw unemployment rise, we saw applications for initial claims for unemployment insurance rise. But eventually, we started to see businesses find other sources for these inputs, and we got back in Q2, a bounce back, just as we had always thought would happen. But the waves of tariffs are astounding. Overall, if you think about all the goods under tariffs, I just love this chart because it looks like I made it up. Those are all imports at a monthly flow rate, all imports of goods from China that are under tariff. And just 13% average tariffs through the data that are available here, you saw a 40% reduction. So how do people normally model tariffs? They usually say tariffs are taxes. You know what happens with taxes? Taxes push up prices, and higher prices, you move along the demand curve, and if you assume unitary elasticity, blah, 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 and they're just wrong. First of all, the direct effect just on what's bought is much, much higher than those assumed unitary elasticities. And second, you get these nonlinear effects from the disruption of production. For all of those reasons, these tariffs have been massively disruptive, massively destructive. We got a bounce back in Q2, but then we got another wave of tariffs. And so just to keep people up, we got more tariffs in September. In May, we got more tariffs just on Sunday on mostly now this time on finished consumer goods. And then we're going to get another increase in the tariff rate for things that already had tariffs in the beginning of October. And then we're going to get another wave of tariffs in the middle of December. That is a problem. Oops, let me That last chart is actually just for Constance. That is a problem. Why is it a problem? It's a problem because this type of disruption is going to happen again and again and again, and that's why we think that the economy is going to slump in the first quarter of this year, and as a result, the unemployment rate is going to drift up. But for the trade war, the US economy is strong. We are now in the longest expansion on record. It could have kept on going for a long time. And so the last thing I want to say is, how far could it have gone but for the trade war? And my answer is quite a long ways further. And I'm going to wrap up with this last thought, which is one of the questions that came in that Kim shared with us is, shouldn't the economy have been coming to an end, the expansion have been coming to an end soon? Aren't we going to run out of labor in the labor market? Aren't we going to hit resource constraints? And my general view on that is no. And so we have the labor force participation rate in this chart, which is for the aggregate economy, it's the black line. The blue line is just prime-aged workers, people between the ages of 25 and 54. Why separate out the entire population from the prime age? And as an aside, over the next 4 or 5 years, I'm going to hate the phrase prime-aged as I exit my prime, apparently. But the point is, it strips away the demographic shift as the American population gets older. It masks a little bit of what's going on. But what I want you to take away from this is the cyclical behavior of especially the blue line. Every business cycle, you see an increase in labor force participation. The longer the expansion goes on, the more people stay in the labor market, join the labor market. The early 90s, the labor force participation had dipped. I graduated from college in 1992. The job market stunk. I got a PhD. 5 years later, I joined the job market just like lots of other people, and you had this upward trend. The same thing has been happening in this expansion. And not only have we not reached the previous cyclical peak in labor force participation, we have not even yet reached the previous cyclical trough. And so as a result, if it weren't for the trade war that's just pounding the economy, I see plenty of room for the economy to continue to grow, to continue to draw people into the labor force. And then I'll stop.
Cool. Thank you.
Joyce Chang from JP Morgan, and it's a real pleasure to be here. Welcome back to school, everyone. And thank you, Kim, so much for the invitation. You know, I started working, I've known Kim since graduate school, when we both worked together at Schoenholtz Brothers. I hate to say it, more than 30 years ago. But it's great to be here with Seth and Constance as well. And so I thought I would just start by describing the global economy today and how I see it. And I would say pushing on a string. Central banks are trying very hard. 17 central banks have eased. In total, we have 22 central banks easing by the third quarter of next year. And right now, growth is not collapsing. Very similar to Seth, we have the US growing at 2.2%, but we have a slowdown to around 1.5% next year for the US. But look outside of the US, and you now have 9 economies that are in recession. We've just taken down our China growth forecast for next year to below 6% for the first time. We have China growing at 5.8%, but pushing on a string. And so what are the policy tools that are left? If you look around the world today, 42% of the global government bond market is at a negative yield. 60% of Europe now has a negative yield. And many of you here will probably go into finance. I realized as I looked around the research analysts in my group that like 1/3 of them had not worked during a period of conventional monetary policy. They looked at me like I was talking about the Romans or something. But unconventional monetary policy is here to stay. So let me talk a little bit about our forecasts. So these charts, and the bottom right-hand one is really the one to take a look at. You have the benefits of the tax reform, and you could see PMI manufacturing going up, but you can see that it's been completely eroded. And very much as Seth pointed to, it's not just the direct effects, the tax effect, it's the measures of sentiment that we're focused on right now. The outlook for business sentiment and global CapEx. And the question is this going to erode into consumer confidence? Because you can see in the top chart that consumer confidence has actually held in pretty well, and we are now seeing signs of that erosion. So after rising in 2016 and 2017, global trade volumes are now at their weakest level since 2010. The pain is very acute in Europe in particular, where they're very trade reliant. You can see that in Germany, where the new orders are foreshadowing a continuing decline in production. And you can also see now that the hit that we are seeing on the consumer. But central banks have been pushing very hard on a string. But we are seeing that these major geopolitical shocks are now turning into economic shocks that are depressing global economic growth. And this has brought on a broad response from central banks. Even though we don't have synchronized views on the political views, we do have synchronized central bank easing in place right now. But what we're worried about as we look ahead is that Trump's trade war is hastening a Japanification process, low growth, low inflation, weak earnings, zero negative yields across regions. We now talk about, could you have zero interest rate policy in the United States? If you have China's growth slow down to 4.5%, given where their debt level is, could you be talking about zero interest rate policy in China? And these kinds of questions, we were not asking ourselves even, 18 months ago. So, this year, China still has the scope on the fiscal side to deliver something that will still be above 6%. But we do have a slowdown below 6% next year, and we do have the US in the third quarter of the year slowing down to 1.5%. Some of the questions that had come up had been about what is the risk of a US recession. So I thought I would spend a minute walking through our US recession model. Now, we have a higher probability of recession than conventional wisdom. We have it at around 40 to 45%. And I think consensus has been around 27 to 30%. So what's in our recession model, and why are we at a higher risk? We put a higher emphasis on profit margin and margin compression. And we estimate that the tariffs have actually taken about $7 off of earnings per share. And if you put the full tariff into place, if they actually went ahead in December, that you would have several more dollars taken off of this. But we look at a couple of things, many of them which Seth also talked about, the tightness of the labor force conditions, the demographics, but also we have seen. If you look at our recession model and you look at where we've seen a pickup in the numbers, it's the ones where you see the biggest jump, more than 7 points, is business sentiment. And so when you do get to the next recession, you're likely to see all of the central banks facing an effective lower bound constraint. And you're going to see that unconventional tools, QE, the enhanced forward guidance, are going to probably prove much less effective as a result of the past decades R-star drop and also the yield curve flattening. So this points to the need to prepare for the next recession now by putting in place facilities, which many of these tools have really been exhausted. So that's a 12-month view, the 40% chance of recession. If you go out 2 to 3 years, we're at over 50% chance of recession. So I wanted to just say a few things, like what kind of recession is it? It's the question I get. And I would say, it's not the 2008 global financial crisis. You haven't had enough normalization to have that type of recession. So it is more, I think, a recession led by an asset class sell-off rather than a business cycle event. You've had, if you look at the equity market, this current cycle has gone much longer than the average equity market rally. And although there are imbalances in the US economy that are ample, they're not glaring. And they're concentrated more in the government sector. So something like household debt was 1.4 times, was 1.4 times income, and now it's about 1 to 1. Because we've had such low interest rates, even though you have more corporate debt, the debt service burden is more manageable. So I think this is more of a asset price-led recession, more akin to what you saw like in 2001 than it is something like a systemic global financial crisis. But when could this be coming? Again, it's not the working scenario for the next 12 months. But could you see this actually playing out and the market pricing it in more as you get towards 2021? And that brings us to the yield curve, because a lot of questions have come up about the yield curve. And I would say one thing is that as we've looked at the negative yields, we calculate that every 10 percentage point increase in the share of negative yielding debt actually flattens the curve by about 6 basis points. So you've got this record amount of negative yielding debt. And questions about whether this is going to actually spread to the US, to China, to other countries over time as well. So the yield curve has always been a bad omen, but we are in a different point on the yield curve than what we have seen previously. Typically, the yield curve inversion is a sign that real policy rates have become too high, and that's certainly not where we're at today. So this time around, the real rates are not much above zero. Claims have been much more resilient. So I think this is an indicator of extreme market nervousness at present, and it's of increasing central bank action. It's also technical factors. The sell-off we saw in treasuries in early August, we think that that was attributed largely to high-frequency trading, which was about 80% of the volume that was traded. This was not really humans trading it. This was more of the machines trading it, which led to the magnitude of the move that we saw in treasury yields in early August. But you do see that in this chart that typically when the yield curve, you have a lag between the yield curve inversion and the actual market peak and recession. That has, if you look at the last 6 episodes, that's been about 17 months on average. So recession, not necessarily around the corner, but more market nervousness, more warning signs. And then I'll just point to one slide on China, just to talk a little bit about the way in which we're trying to monitor US-China trade. So we've been doing more work with big data and AI. And so what we've done is we've taken about 25,000 company reports, the call transcripts, the news headlines, and we mined them to the millions of words to try to get higher frequency sentiment indicators. And it's an interesting chart because you could see in the second quarter of 2018 that the most frequently mentioned words were tax reform. Everybody talked about the tax reforms. You could see that chart. Then it switched to trade tariffs, and then by the fourth quarter of last year, it was recession risk. And you can also see that for the estimates of how much of the tax benefit has been eroded, we estimate that the tariffs have cost the households on average about $650, going up to about $1,000 as you see the next phase put into effect. So if you look at the estimates that every household got about $1,200 from the tax benefits, you've eroded most of it already, and there's still talks of more tariffs. So it is a more precarious outlook going forward, and very much as Seth and I think Constance will have some of the same points. So we are seeing more talks about shifts in the supply chain and in behavior of companies as we look ahead.
Okay.
I didn't go through all of these. Some of these we saw the questions, so I did slides based on the questions, which I can go back to.
Okay, so the benefit of going last is that I get to do a little bit of a summation of what my fellow panelists have said, and it's just so great to be here. Kim, thank you for the invitation. It's great to be back at NYU. We view it as the US economy is at this crossroads, and very much like Seth, we believe that there is some slack in the labor market. So I love this numbers numb and stories store, but but examples excite economists, right? And so in any case, if you look at just something as simple as the reservation wage that people are willing to take when doing any number of jobs that one can get either on Uber or TaskRabbit, we can see that that reservation wage is actually below, in many cases, the now $15 minimum wage that many people are putting forward. And so this says to me that there is this, in addition to the data that Seth showed us earlier about the rising labor force participation, there is some slack in this labor market. So we're at this crossroads where the Fed could continue to elongate the economy, or it could be worried about inflation. And we know that there really is no reason for the Fed to be worried about inflation here. Any inflation we might get from the tariffs, the Fed is going to so-called look through because their dilatory effects on the overall economy are going to be much more significant from the view of the Fed. So let's look at GDP and how it has been doing. And I would say that Q1 GDP is entirely a function of trade distortions. So we go through some components of GDP. Obviously, there's the headline number there up at the top. We have consumption, which fell in the first quarter, and you may recall that we had a government shutdown for the month of January. So that really impacted consumption. We had business investment decline. That was a worry. And we had the 5th consecutive quarter of a decline in residential fixed investment, so housing investment. Also a worrying sign to us, one of the leading indicators of a recession. And finally, of course, because of that government shutdown, we had a decline in government spending, which we expected would rebound. But here's the rub. With exports and imports, the way this works, of course, as you know, is net exports. And you can see that that decline in imports to 2.5% compared with an increase in exports, 4.8%, that caused that to positively contribute to GDP. And it's what gave us that 3.1%. So looked at another way, you could look at Seth's data around final sales to domestic purchasers. And if we combine the first half of the year together, so we look at the first and second quarter together, we still see slightly slowing growth. We see consumption holding up. And it's really, again, this business investment in real estate where we are concerned. And as Joyce pointed out, trade volumes have fallen. And we see this, both exports and imports declined in the full first half of 2019. And so we expect a slow decline of GDP towards potential of about 1.8 with a lot of risk on the horizon. So let's talk for a minute about where that risk could come from. So we have our sort of list of essential recession signals. So obviously the shape of the yield curve, which Joyce talked about, housing investment, the tightness of the labor market, liquidity conditions. And when the tariffs first started being applied, we thought, how are we going to put this into our model? And so one of the things I did was I shocked our model with a higher VIX, a higher volatility index. And what that does is that has reverberations throughout the entire capital markets. Of course, it corresponds to a sell-off in equities, but it also corresponds to a widening out of corporate bond spreads. So the cost of capital for firms goes up. They're less likely to make investment. And so we were able to get a window into how much we would need to adjust our CapEx and corporate investment levers in order to really get a feel for how this would begin to impact the economy. Then we also look, Joyce talked about consumer sentiment, and what we do is we look at consumer current versus future expectations. It looks a lot like the inverted yield curve, actually, and it maps it pretty closely. And then, of course, we look at global conditions. So this is the global manufacturing PMI. It's a heat map. It takes us from December to now. It's organized by geography. The top is Europe, and of course, as Joyce mentioned, Germany is really not doing well. But we can see, with the exception of Greece, which of course is a very small economy that until very recently was doing pretty terribly, we see a lot of sort of yellow and orange within Europe. Within the Americas, Canada and Mexico are doing slightly worse than the US, but the US PMI data that just came out also shows a decline close to that 50 number. And then, of course, within Asia, while China is slightly above 50, we see a lot of countries that are at or below 50. So generally, a concern around the manufacturing cycle. Now, in the past, when the Fed has done insurance rate cuts like they have just started, right, it has actually worked to expand the economy. And in both cases, if we look back, we had a fall in manufacturing PMIs, we had a fall in industrial production, and those are manufacturing is a very interest rate sensitive sector, so it responded to this pullback in rates. It is unclear, given the noise around trade, and I think Powell really alluded to this in his recent Jackson Hole speech, it's really unclear if the Fed tools are sufficient at this moment to have the same impact they had back in the 90s. Oh, And I set myself for 6 minutes, so I'm going to wrap up very soon because I know we want to get to Q&A. It's very unclear that we're going to have the same impact, and the Fed is going to be able to have the same impact as they had in the 90s because we have all this ancillary noise around the trade war. So just a little bit on the negative yield curve. Campbell Harvey was really the first person to come up with this, and one of the things he looked at was the 5-year bond minus the 3-month treasury, and that it had to sustain for longer than 1 quarter. And of course, you can see not only has it sustained for longer than 1 quarter, but it has amplified. And if we look back, of course, it's been an exceptional predictor of recession, as Joyce pointed out. And the reason for this, of course, is really highlighted in a recent New York Fed survey that they did last November. And they asked banks, would they tighten liquidity conditions if the yield curve inverted even just slightly? And so for consumer and industrial loans, 19% said they would tighten liquidity conditions. And for commercial real estate, 40% said they would tighten liquidity conditions. So you can see that this reverberates out into liquidity conditions throughout the whole economy. Now, will the Fed's insurance rate cut work? If we look at the FOMC forecasts, they think it will. They think it's going to work. This is the June summary of economic projections, and it is the August survey from the Wall Street Journal on average. And you can see that private forecasters are somewhat below the Fed. Having just been out at Jackson Hole and having had the chance to speak to many Fed officials, I am less certain now that we are going to get more rate cuts than I was. And that is because, again, it's this efficacy of the tool in the face of the exact challenge we are up against, which is what's happening with the trade war. So I think that there's a lot of questions, legitimate questions around the efficacy of this tool given the current environment. So if we just look at the positive and negative factors, there are a number of positive factors. As Seth pointed out, we have steady jobs growth, we have low inflation, we have this Fed insurance rate cut, we have seen a bit of a productivity pickup, but the negative factors, residential real estate disinvestment, which we actually think is probably going to turn around as a result of the jawboning down of interest rates that the Fed did in the beginning of the year. We've seen mortgage rates come down substantially, and then, of course, the actual rate cut. We have trade disturbances, we have slowing CapEx, we have some labor market tightness in certain industries, we have a possible recession in Europe, we have China slowdown, and, of course, the ever-present possibility of a financial market shock.
Well, first, let me thank the panelists for living up to the 5 to 10 minute limit. I appreciate that. And for excellent presentations. Thank you. This is now your turn. So just a reminder, hopefully Slido is going to come up in a moment. There it is. This is your chance to submit questions by going to slido.com, enter the join code 2222, and go ahead and submit questions and vote on questions. The ones that are voted up will tend to be the ones that I try to transmit to the panelists. One requirement, no anonymity. You have to supply your full name if you want your question to go through. So with that, I mean, the first question that got voted to the top, Seth actually, I think it was Joyce who actually provided an answer to, which was, what's the probability of a recession over the next 12 months? And I think your number was in the order of 40%, am I right?
Yeah.
So do you guys want to add to that? Do you have a different view, or how similar? Or?
So I'm officially at 40%, but I should say that every time the New York Fed's recession probability indicator gets above 35%, there is indeed a recession. So
which makes you wonder if they don't need to recalibrate the numbers.
It might need to be. I think it's based solely on yield curve inversion, or mostly on yield curve inversion. And I would just add that in the beginning of the year, I was the first economist in the Wall Street Journal survey to say that the Fed next rate move was going to be a cut rather than the increases that everybody was expecting. And it's because of this noise around the trade war just adding to so much uncertainty and the slowdowns we were already seeing in residential real estate and then the impact on CapEx.
Great. Oh, yeah, I think mine still works. You can keep it. Yeah. So I'm totally comfortable with the numbers that Constance and Joyce both have out. So our forecast has growth in the first half of next year down at 0.5% or a bit less than an annual rate. And when you get down to numbers that low, it basically takes somebody sneezing in the wrong direction to tip you over into recession. But it takes something, and so what else could go wrong? So the US is now an oil producer. I think that's probably, with this audience, received wisdom, but people our age remember back to when higher oil prices were bad for the US and lower oil prices were good for the US. That's just not the case anymore. And so if you think about 2014, 2015, massive fall in oil prices, particularly large slump in investment spending because fracking has got this flow of investment spending. So if the global slowdown is enough to push, call it WTI below $40 a barrel, that'll be enough to push us over into recession in the first half of next year, and that's not a low probability event.
That's great, because it's the opposite of the 1990 shock when oil prices jumped and it tipped us over into a recession.
Exactly.
Okay. Okay, so the next question is really not, well, it's orthogonal to what we've discussed. If there's a no-deal Brexit, how do you see that affecting the US and global economies? Someone want to jump in?
I've got a
Joyce,
slide.
go right ahead. Your lapel mic works.
I'm the one with the non.
Oh, okay. I'm just going to try to see if I can pull up
sorry.
the slides. I don't know if I can do that or not, or if it'll go back to it.
Can we get back to the slides? That's great.
I had seen the questions in advance, so I prepared some slides based on the questions. So on the global economy, I don't think the impact is that big, but on the UK economy, it's big. And it kind of looks like it's taking a playbook from Italy. You're going to extension of Article 50, early elections. They delay this. So we have the probability of a no-deal Brexit at about 35%. I mean, the bigger risk really is going to be the possibility of a general election, which we have at 40%. The implications for the global economy are not that big. It's the UK economy. Do you really see, I mean, look, back of the envelope numbers, I mean, if you think China is slowing down, we estimate that every 1 percentage point slowdown in China takes global growth down by about 0.4%. So if you think over time, China's growth is going to come down, then that means could potential European growth be 0.6%? The UK below 1%. This is much more about Europe in a recession, something that all of us kind of talked about. But what I think will happen is that you'll get some extension past the Halloween, October 31st. And you see what the events that happen today, and then this call for early elections. And you see that playing out in Italy as well, but just a sharper slowdown than expected in Europe, not just on the trade issues, but just on all of the political issues is something that I do think you're going to see in the offing. I don't think you're going to see this event impacting the U.S. economy very much. And what we've done on our recommendations is that we've really taken down a lot of the domestic companies in the UK. Just given what we see, and we see the more resilient ones. There's certain sectors that are going to be more negatively impacted. Autos, for example. And this is another one where we use a lot of big data metrics. We actually look at which what UK companies are saying about the vulnerabilities of certain sectors. So you have that a lot of the construction and auto related sectors are going to be hurt more. But this is not something that's impacting our US forecast much.
No, I think we're in the same place.
Yeah.
Okay, this question is again orthogonal. It's about the volatility of Asian markets. Now, they mentioned specifically Hong Kong and India, but obviously other markets in Asia are also volatile. How do you see that affecting the rest of the global economy?
So I'll just jump in quickly, and I would put it in a similar bucket to Brexit. What's sort of remarkable when I think about global linkages, you can have two primary types of interactions, and I focus exclusively on the US. And so, but for any economy, you can have direct trade effects in and out, and that can affect the economy. And then there are financial market transmission channels, and that matters a lot to the economy. What I find probably much more important for the US is going to be the latter, the financial market transmission channel. And so the way that Brexit might, don't think it will, but if it did have a big effect on the US economy, it would be a global pullback from risk-taking as people freak out, and you see credit spreads globally widen out. Similarly, for countries like China, or for India or others, probably not going to have that big of a direct effect on the US when it comes to trade flows. But if there were a financial sector meltdown that causes the whole global economy to pull back from risk, here I'm thinking back to 1997, 1998, the East Asian financial crisis, the Russian default. In principle, those things should have had almost no effect on the US and global economies, but in practice they had a much larger one because global financial markets pulled back.
I would just add that something Joyce touched on earlier, which is the amount of indebtedness that there is within the Chinese economy. And this is a worry if China's economy slows, because they, if you're spending a fair amount of money servicing your debt and your cash flow slows, you're not going to be as able to service that debt. And so to me, that is the biggest concern. And we're already seeing global liquidity change in terms of just how China is treating the rest of the world. So foreign direct investment, for example, into the United States as a result of the worsening relations is certainly impacting industries within the U.S., but real estate we see very significantly. So these have reverberation effects. That transmission channel is not isolated, right? It starts to impact everything, and so I think it comes down to, it depends on the timing, because if we're in that place where the U.S. economy has slowed, where this second wave of tariffs starts to take a bite out of consumption, is continuing to take a bite out of investment, if we're at that 0.5% growth rate and this type of sneeze occurs, it could push us into recession. And what I worry about is a confluence of these events occurring together. So if we had the timing of a Brexit with the timing of a sort of greater disturbance within the Asian capital markets, with the effects of the tariffs all taking place at the same time, then we would be at greater risk.
Yeah, and I can go back to the slide.
Can you go back to the slides for a moment? Thank you.
Sorry. Again, let me just start with big picture. We see that every 1 percentage point decline in China's growth takes about 0.4% off of global growth. But the impact on emerging markets is bigger. So for example, for Latin America, we think that every 1 percentage point decline in China's growth actually takes more than 1% off of Latin America's growth because it's a commodity exporter. So for emerging Asia, you have a 1% decline in China's growth, and you're taking 0.6% off of Europe, only 0.2 off of the US, because it's not as sensitive, and you're taking about 0.6% off of emerging Asia. So China slows down, the rest of Asia slows down. Asia, this year is about a 1.5 percentage point contribution to growth. It's about 50% of the contribution to global growth, because China is 30% of that. So when you're talking about a slowdown in China, you're really talking about a slowdown in emerging markets. Because you have so much dependency because of the commodity cycle on Latin America, because of the manufacturing and the tech cycle on Asia. And then Europe is also more trade reliant as well. So that really does feed through. The US actually has less vulnerabilities, which is why I think Trump has felt emboldened to go ahead with this. But when we've actually looked at the real supply chain effects, how much of the supply chain has moved? And so what the graph shows is companies indicating that they are thinking about shifting the supply chain. So that's gone up to about 40%. You can't do that very quickly, right? So this is more how the sentiment, again, is changing. And I think one of the questions was, who are the winners and the losers from all of this? Well, they're not really winners. You can say Vietnam is a winner, but this is pretty small. And Vietnam is one of the winners, but certain other countries like Mexico, for example, which presumably should have benefited with a trade agreement, except that Trump said that even after signing it, he could invalidate it. So you haven't seen many winners off of this. You've seen more discussion about moving the supply chain. That's actually much harder to do. Even if you're thinking about it, to actually physically move that in a rapid way. So the effects on Asia are very significant. When you look at Asia overall, it's India and China that are really about 70% of the Asia story. But when we looked at the vulnerabilities to supply chain, it's the North Asian countries that are hurt the most, and then the ASEAN ones, Vietnam, to some extent, Indonesia, that benefits the most. But you do have a severe impact on some of the countries, Taiwan. And then you have, like, look in Hong Kong, just given what has been happening there with respect to overall activity, there's a slowdown that's happening, irrespective of the particular trade issues as well.
I think you've just answered the next question too. So I think we're gonna move on from that one. Namely that there may be some countries that are benefiting from a shift of activity, but not large enough to make a global difference, right? Okay.
I would just add, some manufacturers that are exporting to Asia, because we are exporting to China. We do export to China, and we export some pretty specialized goods to China. And I have spoken with several clients who are thinking about, could I shift my manufacturing to Canada? Could I shift some of my manufacturing out of the US to Mexico, to Canada, so that I could export to China without having these tariff effects? And it's interesting because they're not so much overt tariffs, but things like, well, we have to have a physically signed purchase order, so we can't send a PDF, we have to print it out, and we have to FedEx it to them. And it just little things that slow down our ability to export to China. And so I think it's hurting us in shifting supply chains, not just out of China, but also for companies that want to continue to export to China out of the US where possible.
I think when France wanted to limit Japanese car imports, they required that they all go through the clearance operation in Poitiers, which had one clearance officer. Speeds things up. So looking at the world as we see it, with more than 40% of government bond markets yielding below zero, what are the best safe haven assets for investors in a world that's as troubled as the one you guys have described?
One thing that's funny, when I was Assistant Secretary of the Treasury, I would do trips around the world to talk to investors who have large holdings of US Treasury securities, and felt like a little bit of the federal government's Willy Loman out sort of flogging my wares, and I thought we could get t-shirts that said, buy treasuries, as safe as boons and 4 times the yield. And now the factor by which they have more yield is infinite, given that the boons are negative. I think part of the reason, and Joyce definitely alluded to this, about this, and Constance as well, the low long-term rates in the United States is because treasuries are paying positive yields. Lots of otherwise safe sovereigns are paying negative yields, and so it's starting to pull things down. So I think from that you can infer that global investors see U.S. Treasuries as one of the best places to go. And every time we see a risk-off event, Treasuries rallying further sort of reinforces that notion.
And the dollar too.
Yeah, and so you've seen that even with 1.5% growth for the third quarter, it's still U.S. exceptionalism.
Yeah.
So stronger dollar, gold, high-grade bonds, and U.S. Treasuries have been the winners. I mean, and the U.S. equity market has also held in, relatively well in all of this, because still at 2.2% growth, when you look at the other economies that are going into recession, this is still a growth differential that looks attractive. And the way we look at it, the capital flows really are very dependent on the growth differential. The U.S. still is, with the positive yield, with the growth differential, you've had still, even with more volatility in August, much stronger performance in the U.S. markets than in other markets. So I think that the question is, when are you really sort of running out of these tools, and at what point will some of this sort of play out? And I think you can see through this year, we have one more Fed cut, but we don't have any program in 2020. The market's pricing in 5. So at some point this will come home to roost, given where expectations are. But again, you're very late cycle. You're 11 years into the cycle. And that's more than double what a usual cycle runs, which is why I do think it's going to be more of an asset price correction that will be sort of leading, rather than necessarily seeing this huge shift in the economic indicators so rapidly.
Are there any other implications of having these incredibly negative yields abroad on the economy of the United States? One question was also specifically about how does that affect bank stocks?
Well, it's certainly a challenging environment for banks, right? And Japanese banks have been dealing with this for a number of years. European banks are having a hard time dealing with it. And the negative yield curve in the U.S., if it persists, will of course impact U.S. bank profitability. But I think the bigger impact is on insurance companies and pensions. Yeah. So I'm on the advisory board of KPMG's pension, and having negative yields around the world certainly challenges us to figure out how are we going to meet our performance targets without moving too far out on the risk curve. And this is a challenge that everybody running a pension has. It is a challenge that any insurance company has, especially European insurance companies, where they, from a regulatory perspective, have to put a certain amount into government bonds. And so it's a really big challenge. And insurance really is one of the backbones of our financial system.
Great. Anybody else want to add to that?
No, I would just say that it's raising a question on whether you're going to have to buy more in emerging markets just to get a positive yield. So even if you are concerned about the geopolitics and you're concerned that still both the growth differential and the yield differential, is that going to push you into this? And even with everything that's happening in China, as China goes into the mainstream indexes in both equities and in fixed income markets, will just that search for yield push you into more of these instruments? So you've seen, demand for high yield instruments just because of the negative yields, and it's the pension gap. And the demographics, which that gap has just been widening. But there's also I think, real question mark on just there's a debate on when could the U.S. actually hit the zero interest yield rate bar as well. I mean, when you look at this, when you have like the Fed funds rate as your highest yield because the long end is so low, it's so there is a question: are you going to have to actually take a look at emerging markets, local currency debt, including Chinese debt, because of the yield?
I guess the next question seems to be about psychology and how it's formed. A question is whether the media attention to the recession risk is actually prompting people to expect a recession, including forecasters.
Nothing to fear but fear itself. There's certainly an element of that. And I think this is why the trade war is so pernicious, because it gets right at the heart of the sentiment. And if you were just basing it on the economy, we wouldn't have necessarily seen a slowdown in corporate investment the way we've seen it. Residential real estate, yes, we might have seen, because there's some particularities of the real estate market, and I think that there was a real psychological barrier. Again, for anybody on this panel, interest rates for real estate is very, very low, but for many people who are, who are just entering the home buying market, they've seen rates very, very low for most of their adulthood, and so this move up seems very dramatic for them. But that sentiment factor, I think, is, and I don't know, you guys opine with the cycles you've seen, but it seems to be much more of a discussed factor in this cycle, and I think that is because of the psychological effects that the trade war is having. And when I say the trade war, I don't mean just U.S.-China. As Joyce alluded to, or said, that Trump, told Mexico, well, I signed this, but I could rip it up tomorrow, right? There's this general uncertainty.
On Mexico.
Yeah, just that there's uncertainty everywhere with regard to this aspect of the economy, which had been growing and expanding for so long, is really, I think, having an outsized impact.
So I took part of the meaning of the question probably wrongly. Does it affect people like me who do forecasts of the economy? And for me, the answer is an emphatic no, partly because I know a lot of reporters, and so that's part of it. But I think on the other hand, people's fears matter for how they spend money, but ultimately, I suspect at the end of the day, the average household, if they were to come home at night after a long day, sit down at the coffee table, honey, how's your day? Well, I read the newspaper and the New York Times told me that there might be a recession, and that makes me worried. And then the other spouse says, yeah, but I just got a raise, so let's go out for dinner. That, for me, the actual cash flow for most households, I think, matters more. The actual employment prospects matter a lot more. Similarly, if the media were to be telling everyone everything's great, everything's fantastic, and then a bunch of people get laid off, I bet they cut their spending a lot, even though the media is telling them that everything's fine. So I think how people spend their money and how much money they receive sort of matters first order much more than the
So the one thing I would say is, 30 years as a research analyst, we've had to develop these big data, more, natural language processing tools, just because, like Donald Trump tweets on average 13 times per day, right? So if you're trying to track all of this stuff, so you can talk about recession risk, but then there's just like the sheer number of tweets that you need to, follow and that the market is reacting to. So we've created, we have our trade war index, that was the graph that I showed, but we also created a geopolitical anxiety index and a populist sentiment index. And a lot of this is just actually aggregating a lot of the newspaper headlines, the company earnings, and the transcripts. But you see a lot of interesting things. It's not just the recession risk. Like if you look at our populist sentiment index, the most frequently mentioned word now is socialism, which you would not have seen before the US midterm elections. If you take a look at our geopolitical anxiety index, it's saying, look, 2020 US elections is a far riskier prospect than what we're watching in Europe. So, I think part of the reason why, is it about the press reporting on it, or is it just that the way that social media has changed communication and the frequency of that communication, that waiting 3 months for indicators to come out, you need to incorporate some alternative data metrics into this now, and other ways in which you can get higher frequency reads on sentiment. On top of that, the whole way in which the market has traded also has changed as liquidity has declined, market depth has declined, as you've moved to more passive investment, algorithms, and the market moves are happening in these flash crashes. So the combination of those two things, it's just kind of changed the whole way in which the market function is playing out.
The next question is about something you guys have all begun to address, namely, what tools are going to be available to central banks in the next downturn? And having spent an early part of my career focused on Japan, I'm sort of, one way to pose this is, are we all becoming like Japan? Are we going to be running out of monetary policy tools? And what else is there?
Well, and one could say Japan has also run out of fiscal policy tools now as well. Barring some sort of productivity miracle, I would say that the efficacy of the tools has certainly we seem to be at some limits. And I think if we ask what's the value in Europe reducing rates even further and going further negative, there are a lot of valid debates valid arguments that say that is not going to be effective.
So I want to push back a little bit the way you distorted the question, because it said officials, will they have policy tools, and you made it narrowly about central banks. And I might actually take the opposite side of part of what Constance said about Japan running out of fiscal policy. I think I'm not worried about policy tools. I'm worried about political will. This expansion went on for a long time, but the unemployment rate took a painfully long time to get down to a low level. It took a long time, and as I said before, I don't even think we're anywhere near actual full employment. I think there's a great deal of extra slack in the economy. And one of the reasons for that, in my view, is the Budget Control Act. So we had contractionary fiscal policy in the United States at a time when the unemployment rate was quite elevated, and at a time when the economy was only barely operating above potential. Why did that happen? It is because of sort of a lack of political will and lack of right thinking among policymakers. And that just seems to be a history of policymaking in the United States, but also globally. So when I think about, the screams about fiscal responsibility, fiscal irresponsibility, think back to the last time we had a budget surplus at the end of the Clinton administration, that had nothing to do with any particular virtue of the Clinton administration. It had everything to do with the inability of the government at that point to spend a lot of money, combined with a really, really, really good economy at the same time. And then at the first chance, formerly fiscally responsible politicians decided to blow up the deficit, and so we have it again. So I don't worry so much about the tools being available. I worry about the political will being in the right place. And same thing with Japan, the fact that they're again contemplating another sales tax hike, or about to implement it, is just for me sort of beyond inscrutable, because it's precisely the opposite of what you think you might want at this point. And for Europe, I sort of think it's remarkable that the Germans inscribed in their constitution a balanced budget amendment, when what might be best for Europe right now is if the Germans could pass a tax cut where every German gets 5,000 euro, half of which have to be spent on vacation in either Italy, Spain, or Greece. If you do that, Europe is saved.
So I would just add, so 2 points to what Seth and Constance said. I'd say that first of all, I'm going to take it back to China because China is about 30% of the contribution to global growth. So our forecast is that actually by 2030 this will come down to 20%. It's going to take a lot longer for China to be the size, of the U.S. economy. So our estimate is that at if you look at China's debt burden, the estimates are anywhere from the high 200% of GDP to higher than that, depending on how you calculate the debt. Our estimate is that they spend about 70% of their credit growth right now just on the debt service. So there's this whole question on whether you're going to go to a Japanification in China first, as growth comes down to more of a 4.5% range, and we have growth coming down to 5.8%. So there's an issue on just slowdown in China and the implications of that to the global economy, which has broader implications than even the U.S. slowdown, in my point of view, and the constraints that they have as far as the tools. The second point I would make, I was at a central bank seminar where they asked me to give the markets presentation, and it was one of those days where the central bankers were sort of having a pity party for themselves. They're like, why are we getting blamed? We're the good guys. We saved the global economy. And they're like, well, what do you think the market expects? I was like, look, BOJ buys equities and ETFs. What do you think the market expects? It's they've seen it. Fallen angels, that happens. You guys, is there going to be some expectation that that policy on the public policy side is going to have to move beyond? You've seen a template with, if you think it's really Japanification, you know what BOJ has done.
I'm going to skip one and come back to it, but Fed independence, how worried are you?
Not worried. Not worried.
Wow.
Yeah, from the Fed's perspective, right? Nobody at the Fed, everybody at the Fed takes independence completely seriously, and they are not being swayed.
Okay.
So I completely agree with that last statement. On the other hand, I'm very worried about it, but maybe in a broader context of the deterioration of institutions more broadly. So the bouts of Fed independence, lack of independence, back and forth, there's a long history of that. And for anyone who's interested in this, historically, there's a great book by two people who are in DC. One's a professor at George Washington University, the other is sort of a retired hedge fund manager, but about the long history of Fed independence and lack thereof. It's quite fascinating. But I think it gets back to generalized waxing and waning of respect for institutions and how government should work. And so when I think about someone like Jay Powell, who I first met Jay in 2012 when he joined the board, and then when I was at Treasury, we worked on joint projects. He is absolutely impeccable in terms of character, and I think he sees his job as being trying to be independent in all the Reserve Bank presidents, and that's the way the Fed is structured, to try to enshrine that. Nevertheless, it is impossible for a human to sort of ignore the sort of commentary that they get on a regular basis, and then again, you end up being backed into a corner. So as the economy gets battered by the trade war, necessarily the Fed's going to react to it based on their objectives to ease policy, and anyone in markets who is now questioning the independence can easily be excused for that, because if the Fed were to give up its independence, they would act in much the same way they would doing if they're just following their mandate. So I worry a lot about it, both because of the perception, but also as a generalized deterioration of institutions in Washington.
No, and I would just say that I worry more when the Congress says that they're going to look into it. It's just that it's getting more politicized. But if you look at the appointments that have been made to the Fed, like the Randy Quarles and the Richard Kluter, they're excellent appointments. They have been independent. They've upheld everything. But I worry more about the politicization when you see calls for congressional testimony, that there just becomes a period where it's just scrutinized in a different way, even if you have like all the individuals who are really acting in a very responsible way. And we go through these cycles. We saw that after the global financial crisis. So this isn't necessarily new, but it seems like you could be getting into one of those periods again.
Well, just following up, I think all of you have suggested that if trade conflict reduces demand, you'll expect the Federal Reserve to ease. we recently had the New York Federal Reserve Bank, former Federal Reserve Bank president, suggest that easing in the face of trade conflict actually encourages trade conflict. How do you respond?
I mean, he's not wrong.
Does that mean do you mean by that the Fed should not ease?
No, I mean that as Seth pointed out, this puts them in a bit of a, shall we say, tautological box.
Yeah, I agree. I mean, I think easing in the face of trade tensions absolutely increases the likelihood of further escalation of the trade war, but I also think it's the right thing for the Fed to do. Similarly, there's been a lot of discussion about U.S. direct intervention in FX markets. There's no question whatsoever the Treasury has absolute authority to be able to do that. Jay, in his effort to try to seem apolitical, did the standard dodge that every single Fed chair has ever done, and he said, don't ask me about that. FX policy is totally the purview of the Secretary of the Treasury. Well, the other thing that is unfortunate in that regard is, not only is that true, historically, every time the Treasury has intervened, the Fed has intervened alongside of it, including times when each Greenspan and Volcker categorically did not want to join in because it was at odds with their domestic monetary policy. And so now, suppose Secretary Mnuchin decides we're going to intervene directly to try to weaken the dollar, it seems utterly and completely indefensible for Powell to stand up and say the Fed's not going to join in alongside the Treasury. That's the history, that's the tradition of what the Fed wants. It's fully consistent with the accommodative lean that he's put in place as chair. And yet, in an instant, that will ratify in so many people's minds that the Fed is utterly and completely captive to the administration, and they are now, with the administration, directly engaging unilaterally in efforts to weaken the US dollar.
I don't have much more to add to that.
No problem.
Yeah.
Again, a series of orthogonal questions. Michael Burry, the infamous fund manager from The Big Short, believes he found the next bubble in passive investments. Do you agree?
You've had, I think there's three things that have happened with market structure. First, you've had record issuance and growth of the market because of low interest rates. So if you take a look at the global bond market capitalization, it's increased by about 60% to $57 trillion. So massive growth of the size of the market. Then you've had a lot of the traditional intermediaries have been taken out because of financial regulation. So the banks are not holding the inventories. And then remember that the whole point of the financial the deregulation was you wanted to make the market democratic, that everybody could own it and trade it and pay the lowest fees possible, so you can trade it 24/7. So you've had massive inflows into passive investment and outflows from active management, which almost look like the jaws of death. I mean, if you take a look at the inflows into passive and the outflows from active. And what you are seeing is that with the change in the market players and structure where it's more algorithms, high frequency trading, like if you take a look at the Treasury market moves in August, I mean, we estimate that 80% of that was high frequency trading. It was not that fundamentals changed very much in that period, and we're now measuring things in milliseconds. You take a look at the December 24th market sell-off, where the equity market was down 3% on Christmas Eve. We estimate that you had really something like 90 futures contracts trade that caused that much of a correction because nobody was in. So the liquidity and the technicals really do matter when you can look at the magnitude of the market moves, and and I think that if you're going to do the analysis the right way, given the way that market structure change, you need to be looking at the fundamentals that we always start with in the top-down view, but you need to be able to overlay alternative data, and you also need to look at the market positioning, the technicals, who the players are in the market, who the owners are, what's happening with the CTAs, what the positioning is, going in. And you had the August correction. If you take a look at it, the market depth, and we use market depth. The market depth is different than market liquidity, because market liquidity is the simple metric of your market cap divided by the volume traded. Your market depth is the amount that can actually clear the market. And we estimate that the market depth was actually worse in August than it was during the December sell-off, which had at that point been one of the worst periods of liquidity. Now that was relatively short-lived, but you are going to have to, I think, treat it as a reality that these kinds of flash crashes are here to stay.
Okay. It's not re-ranking correctly on my iPad, but apparently the leading question is about 2020 presidential candidates. Do any of the candidates threaten significant economic instability if elected?
God, I would suspect that all of them do. So one of the wonderful things about the U.S. is, it's not just the presidential candidate, it's also who controls the various houses of the Congress, and that was part of the sort of bad economic outcome of having contractionary fiscal policy when we're below full employment and the economy is only barely recovering. I couldn't quite tell if part of the implication was some of the policies, more progressive policies, would sort of lead to some sort of overall instability because there'd be too much spending or too little spending. I guess one thing that people often point to is, oh my gosh, here's the price tag on any given policy proposal that's going to bankrupt the United States. It's going to cause debt to go up a lot and interest rates to skyrocket. And a lot of discussion about modern monetary theory, and isn't that sort of the hobgoblin that's going to sort of destroy the US? I'll just take everyone back in time to the middle of 2017, or even just after the previous election, and there were lots and lots of people who were saying, oh my gosh, if we have a massive tax cut and a really, really substantial increase in federal spending, boy, that's just going to explode the deficit and it's going to cause a sell-off. We're going to have super high interest rates and cats are going to start to sleep with dogs and people are going to compose atonal music and the world's going to stop spinning on its axis. And it's true. I mean, look how much higher US interest rates are than the rest of, oh, wait a minute, that's not going to be a good argument because US interest rates are much lower now than they were before the trillions of dollars of extra debt were issued. So I think it's, I think there's a bigger context that has to be considered, and in some sense, the best time, suppose my forecast is too optimistic and in fact the US goes into recession in the first half of 2020 and stays there, then if you get a candidate who is in fact a bit on the profligate side and ends up squandering money on people who might just use it on food and shelter and clothing, that might in fact, in a specific context, be the right approach, whereas it might be more harmful in other circumstances. So I think it's very context specific.
Yeah, I would, and I see that we have the next question, which is, given prevalent negative interest rates globally, to what extent would fiscal policy be a more effective platform to counter the next recession? So it ties in to the MMT idea, and look, there's obviously a hot debate about this, and I think if you go below all the hype, it is all about context. It is all about timing, context. Are you spending money on things that advance the economy, advance future generations? Are you doing things like infrastructure spending? Are you doing education spending? Are you doing retraining spending? Are you doing science and technology spending? Right? If you think that the federal government after World War II contribute to over 70% of our R&D spend, right? And now it's come down substantially. Does spending on that type of thing help increase productivity? Does it help grow the economy? There are arguments that say yes. So I think I agree with Seth. It's extremely context specific.
I'm going to just pull up one slide if I can go back to the slides.
Come back to the slides?
So
Joyce is the person you never wanted to have in class with you because she's like always more prepared for these things.
Like, I have a slide for that one.
No. So one of the things I had to do was try to put some numbers around the Green New Deal. So I just thought I would go through the way that we tried to look at this. So like we only dealt with because a lot of the candidates are saying we want the Green New Deal. Like I mean Biden isn't, but all the Democrats, all the other Democratic are saying Green New Deal. So let's just forget about the universal income, forgiving the student loans. Just take the zero emissions piece of it. Just take that. So to get to the 2030 goal, of zero emissions by 2030, what would you need to see? You would have to see overall U.S. primary energy use decline to 1988 levels. You'd have to see solar generation go up 11 times. You would have to see wind generation go up 5 times. You'd have to see nuclear generation unchanged. Remember, the goal was to get rid of it, completely. You'd have to see a 90% decline in coal usage. You'd have to see electric vehicles, EV, in the US go up to 40 to 50% from 1 to 2%. You would need to see oil usage decline 50% due to the electric vehicles. You would need to see household and commercial consumption cut by about 1/3 for the intensity of residential buildings. And you would still only meet 40% of the goal. So some of the proposals by the candidates do not seem economically feasible.
We come back to the Slido questions. That does suggest instability if they try to implement.
Well, I know every campus has a lot of people who are really protesting on this, and nobody's tried to work through the numbers. Like, if you really try to do that exercise.
So,
Okay, I'm going to digress for a minute. Thank you, Joy. But central banks are starting to think about the impact of climate change, and is it going to impact their mandates? So the Bank of England has done a fair amount of work on this. The Reserve Bank of Australia has started to do work on this. Bank of Canada has done some work on this. And so I think this will become something that becomes a much more
Absolutely.
significant part of the policy debate.
No, and it's really clear that this is an issue that there's just such passion around. I mean, you still look at it even at the state level. I mean, even if at the national we've rejected the Paris Climate Agreement, 23 states have adopted it. I mean, you've got the reality that on carbon pricing and taxing, that China looks like it's going to adopt something. And they're going to electrical vehicle usage much faster than the United States because the pollution problem is so bad. They could hit that
Right,
20.
but they also are using. They're also using coal. I mean,
absolutely, they're
so
doing both,
It's
but-
not really. I mean, from an emissions perspective, it's not really
No,
the best choice.
it isn't, but it's not the best choice. But China, on some parts of innovation, like solar and wind, is far ahead of the US just because it's such a problem. So there's no denial of the problem. The solution in the Green New Deal and sticking everything under it, I mean, it's just one of those things where, there should be some level of responsibility in trying to work through numbers when you put out these kinds of things.
Great. The next question is really, the least I have here, is really about how the economic outlook affects student strategies. Assuming there's a slowdown or even a recession coming in the United States, and we already have it in some parts of the world, what are the best strategies for students for managing their own career risk?
Get a good internship.
Yeah, actually, I fully agree with that. It's sort of remarkable when I think about every time I hire, and Joyce has probably hired thousands of people over a career, I get a gazillion and one applicants, and trying to sift through the number of applicants just to get the number that I can do a first level half-hour phone call is painful. And then if I want to be as inclusive as possible, then I do 10 different half-hour phone interviews, and I have to go from that to try to figure out who I want to interview in person. But if somebody I know has had somebody working for them as an intern and can tell me, here's what the person can do, here's what they need to learn, and I guarantee you that if you leave at 5 because you have to go to your kids' after school thing, this person's going to stick around until 8 to make sure that everything gets done. Boy, that's going to go a long way. Not quite as long as an NYU education. I can pander to a crowd like with the best of them. But I think that suggestion is a good one. The other one that may have been evidenced here is when you're making forecasts for things and you have to do it in probability terms, 40% probability of something happening is really, really good, because either you're going to be right or you're going to be wrong. But if you said, it's about 40%, and then it happens, you were wrong, but you had already said it's got a pretty good chance of happening. Whereas if you say, it's not going to happen, it's 5%, you don't want to be wrong in that. You want to be on the right side of things. So pick 40% anytime you have a chance.
I have to say, JP Morgan has moved to, for our campus recruiting, the first round is now through Pymetrics. And they had some of us, do the demo for it, and I have to say I didn't understand some of it. Like, how fast can you push the space button? I didn't actually get it. I mean, maybe I'm old school. So I think that what's very clear is that knowing the data analytics is going to be a lot more important. The Pymetrics is to try to get to a broader pool, so you're not just recruiting from the same school. So I think that is actually a healthy thing overall. I actually, think that is, I don't understand the exercise itself. I think the concept actually makes quite a bit of sense. But I think that, yeah, getting as many real life experiences as you can, and you're lucky to be in New York City where that's really doable, is the most important thing. There's your education, and then there's, really what you've been able to establish as a work record. The other area where we've been just doing a lot of work has been on student loans. And so when people ask me about our recession risk model and they say, look, what are you really worried about? I said, look, I'm not worried about systemic risk in big banks, but I worry a lot about things like auto loans, credit card debt, student loans, and consumer finance. So just to walk through some of the student loan numbers. So you've got student loan debt at 1.3 trillion. I think it's a bigger problem than the leveraged loan market, quite frankly, because a lot of the repayments on the leveraged loan market look more easy to be made than the student loan problem. But we estimate that just the rise in student loan debt has cut home ownership levels for the 18 to 35-year-old group by about 15%. That's a material amount, and it's really changed the way that people live. Like, are they going to own a car? Are they going to own a home? What are their aspirations compared to previous generations? So, look, I do think just the student loan problem, when I look at what I worry about in the next recession, is things like auto loans. Like, our stress tests show, could you see 60 to 70% default? Student loans, like, you already have a very high ratio of delinquencies right now. Things like the consumer finance side of it, not something that's systemic like the big banks. I mean, you haven't had the normalization, and you've had all the regulation that you don't have the kinds of problems that had come about. But that's where I see more stress in the system going forward.
Maybe you mentioned it before. What about stress in non-financial businesses that are somewhat leveraged?
Well, if you take a look at mortgage loans, now 80% of them are from non-bank lenders. So when you hear that Home Depot is doing mortgages, stuff like that, I mean, and that's not as regulated, so I think that's going to be more of an issue.
Okay. Anybody else? We're good? Okay. So again, hard to get the ranking here, but I see something up there. Essentially, this follows up on something that you mentioned. You were arguing that if monetary policy runs out of tools, that fiscal policy will be the natural alternative, and there's fiscal space in the United States to act, fiscal space in Germany, I think you mentioned, and you suggested fiscal space in Japan as well. Does everybody agree with that? Is there any doubt about whether there's an ability to use fiscal policy in the advanced economies in the event that, imagine we're all at zero yields?
No, I think you're going to have to use
I
fiscal
don't
policy.
give a choice.
Yeah, you're going to have to.
Yeah.
Okay.
So I'll just be slightly contrary in that you won't have any other choice. The choice will be for politicians to dither and do nothing and let the recession get worse, and that's actually my forecast.
Yeah, and then you will have that at the state level, they won't want to do anything. So could you do infrastructure spending? Yes, states could do it if they authorize it, but they won't. So, I mean, I don't think you're going to have that many alternatives, but whether it will happen or not is another question.
So let me just link it to something that's been published recently at Brookings, the idea of strengthening automatic stabilizers. Have you thought about that? And how does how relevant would it be in this circumstance?
No, I thought that work that Brookings did was really good, and I think part of the simple version, the boiled down version, the logic is recessions often happen, at least demand-driven recessions happen when spending falls off and then people lose their jobs, and as a result of that, those people spend less, and so it builds on itself. And the idea of strengthening the automatic stabilizers are that when people lose their jobs, their spending doesn't have to fall anywhere near as much, and as a result, the recession is more shallow. And I think that's a absolutely sort of plausible idea that sort of works.
And it avoids the discretion problem that you're worried about, that there might be policy reluctance to act. Essentially, it substitutes for action.
I agree. On the other hand, if you take a step back in that super game, it also reduces the probability of it getting enacted in the first place.
Okay. Anybody else?
And they could always undo it. I mean, but I agree. And I mean, if you look at most recessions in the US, we don't have consumption actually decline. We have it increase at a slower rate. And so going back to the financial crisis where we had consumption actually decline for multiple quarters in a row, that is the anomaly. So if we have a garden variety business cycle recession that's not the result of a financial crisis, I think you would you wouldn't expect to see consumption decline to the extent that it declined during the global financial crisis. So I think a little bit of this work is anchored to that experience, and you wouldn't even have to go terribly far to really help smooth the consumption function under a normal recession.
Okay, actually, each of you have said something about this, Joyce specifically in just a moment ago, but it's worth asking sort of a longer term perspective. How are environmental issues affecting economic growth prospects, not just over the near term cyclically, but medium term, long term? What's the impact?
So I can start with that. We actually took a pretty serious deep dive into this, and looking at everything from the cost of mitigating the impact of a carbon-based economy. So that's very expensive to do the switching, and it actually, if we were to do massive switching, as Joyce modeled out, right, there's costs to that, and so you should look at if you're interested in this, I encourage you to look at Nordhaus's work on this. It's very comprehensive, but then there's also costs, of course, to doing nothing. Right, and those matter, and they matter more in coastal areas. They matter more in places that are getting warmer. So obviously, for some northern climates, getting warmer is actually a short-term economic benefit. So if you look, for example, of being able to do certain types of mining in Greenland that you wouldn't have been able to do, the growing season in Canada becomes longer. But if you look at places near the equator, you're actually having places that are getting too hot to even function out of doors, right? And so if we take this a little bit closer to home, if you were to imagine, and I always get them confused, is it Disney World that's in Florida? Okay. Disney World is in Florida, Disneyland is in California. All right, Disney World obviously is in Orlando, and it's a warm place in the summer. But if you have days where it's over 100 degrees, right? Do you operate the park? Is it too risky? Do people, what kind of risks do you take by doing that? So that's a direct economic hit to revenue by Disney and to economic activity. So we can start to model out these things. And so obviously it's asymmetric, right? The switching costs are upfront costs that are relatively high, but of course the cost of not doing that switching, really you're looking at very, very significant, possibly catastrophic and unpredictable costs. So if we just think about, and this is becoming an issue, by the way, for insurance. So there's a coal-fired power plant that Australia wants to build, and it's possible it's not going to be possible to insure it. And if you look at the insurance question around PSE&G and the fires in California, right, this is starting to impact current economic thinking and current financial modeling of insurance companies. So I'm not sure if I actually answered your question, except to say that it's something that I think more and more financial actors are having to take into account when previously they could have said, oh, that's in the future. It's not in the future, it's now.
Yeah, I guess I would have thought Constance has covered a lot of the negative, and I think there are lots of ways in which it's very, very bad and costly, and I think in terms of long-run growth, you'll end up putting a lot of spending that, and this will get back to the semi-philosophical question I'll bring up at the end, but you'll put a lot of money into things that are fixing problems, and so when you think about what that means for growth, that's not adding anything to overall growth, and so as a result, the engine that's made the economy strong over time, productivity growth, gets whittled away more and more and more over time. If one wants to be optimistic and see, I'm never particularly optimistic. I can see a glass is 1/10 empty, but if one wants to be particularly optimistic, I mean, you could think, okay, as these problems get more and more proximate, it's clear that it's dire, could lead to more spurts of productivity and innovation, could lead to more rapid reduction in the cost of solar cells, wind power, yada, 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 because it becomes more and more clear in people's mind that this is, in fact, a problem that needs to be solved. And then you could end up being off to the races in terms of productivity growth. So there's a reason to have hope as well, but it requires action. I think the part that's a bit philosophic, but leads, I think, to the negative root of bad productivity growth. So, think about the hurricane that is in the news these days. Dorian destroyed the Bahamas, hitting Florida. boy, if it's my house that gets knocked down, I feel crummy and I feel much poorer. But then I go through and I actually pay someone to rebuild my house. That actually gets calculated as part of GDP. And so ultimately, I think as we think about climate change, actions to remediate climate change, the question of do we care about GDP as a metric anymore is going to come up, because if you're hiring someone to build a sand wall to keep the water from eroding your house, I mean, yes, that actually is a flow of a service that you're paying for, but doesn't raise productivity in the long run. It doesn't do very much. And more importantly, it doesn't really make you feel that good. It makes you feel better than if your house got flooded, but it doesn't actually add to anyone's particular utility. So I think the question of what do you actually care about in terms of economics is going to become more and more to the front.
No, I would just say that other parts of the world are moving much faster on what they're doing on the whole environmental social governance. So in Europe, it's mandated. I mean, it's increasingly you have to have a clear policy in place, or shareholder activism. It's just not investable. And in parts of Asia, that's the case. The U.S. has, not adopted it in a mandated, type of way, but that's becoming more the norm, and it's being demanded by younger generations to have that kind of level of social responsibility. But what we've been telling companies is that you need to begin developing a strategy around it, and we've kind of divided it into 3 different categories, like the transfer risk, the liability, and the physical risk, and sort of developing your own plan about it. And very much as Constance said, we've looked at the impact on insurance, trying to put into account also some of the things that Seth had said. What is actually the rebuild kind of get you out of some of this? And so right now you've kind of said it hasn't been that significant, but you've had so many events that have been the worst event of the last decade, like all in concentration, that at the pace at which it's going, and that it's becoming more of a global phenomenon, not just that you look at Brazil, you look at other places around the world, the Amazon, what's happening. It's getting harder and harder to use past precedents as a way to model it. And I think that's a lot of the problem you have with many things that we're talking about in financial markets now. The way market structure has changed. So you can't really look at past sell-offs because you've got the flash crashes, the algorithms. You have the higher frequency data that you need right now. You have it's an unprecedented number of natural disasters. So a lot of the templates that we've historically used need to be changed. And that comes back to the point of what kinds of skills you need. And you need to have sort of the data science skills, and so much of the data has been created so recently, and the higher frequency nature of it, and to be able to incorporate that into the way in which you think through investment processes, economic processes.
I hope you'll join me now in thanking everyone on the panel for asking those questions.